So one thing a first-time home buyer may not realize about their 30-year mortgage is that in the first 5 years, most of your payment is going to your interest rather than your equity. 30-year mortgages, they're amortizing and they're notorious for most of your monthly payment in the first 5 years going to interest payment rather than uh, towards building that equity. And it's usually close to like 85–90% of your payment is going to interest. So you're not building equity as quickly as you think. Now, granted, most of your property appreciates about 3%. And so you are building some equity still, but it's not nearly as much as you might think. In fact, for most home buyers, they refinance every 3 to 5 years, which means they're sticking in that sweet spot of equity because they're trying to consolidate debts or pull out equity to do repairs around the house or whatever you need that money for. But it keeps you in that sweet spot of most of your payments go into equity, you're making the bank secure, but you are not growing your wealth in any substantial way. So there may be other strategies. You should really work with a CLA if you want to focus on maximizing the equity build rather than the interest payment.